Well, how far did home prices fall during the great financial crisis and the housing crash in 2008? That's what we're looking at tonight on the Housing Nerd, folks, because a lot of people have kind of predicted that we are headed for another housing crash like we saw back in 2008. And I thought it would be important to take a look at the data and understand exactly what happened to home prices. Where did they crash? Where did they not crash? And kind of some factors that led up to the home price decline. And so that's what we're covering tonight on the Housing Nerd. Thanks for joining me. My name is Jason Ferrier. I am a realtor and investor just outside of Columbus, Ohio. And I've been doing it now for about 7.5 years. If you came to this live or the Housing Nerd expecting me as a realtor to tell you you should buy a home, you came to the wrong channel. I'm not going to tell you that. I'm not going to tell you to marry the house and date the rate. If you came to the Housing Nerd expecting me to tell you that the housing market has never been so toxic and now is the worst time to buy real estate or invest in real estate, you also came to the wrong channel, because that's not my job. I'm not going to tell you what you should do with your money. But what I am going to do is give you the data you need to make an informed decision. So that's what the channel's about. Let's get started on this information. And as always, like this video if you jump on the live, because when you share it, it'll push it out to more people to get involved. And subscribe to the Housing Nerd if you haven't already. All right, let's get going. So what you're looking at right now is the home value change from 2007 through 2011. And I'm looking at the top 100 metros in the US. So you can easily see here in the legend, if you will, that the red is bad, blue is good. And immediately what stood out to me when I looked at this map, because when you map this thing, it looks much different than when you just look at like a chart, right? Which we usually look at. But this map to me really stands out because guess what? Through 2007 through 2011, there were markets that actually went up. Like the housing market crash, the price crash was not universal. And one of the reasons why I created this map and wanted to do this video in this topic was that I hear people talk about the fact that home prices, when they do crash, because everybody thinks they are going to crash, not everybody, a lot of people think they're going to crash, that it's going to be universal. There's not going to be one market spared. Well, if they go back and look at their history, they would see that there were markets that were spared during the GFC. Many weren't, some were. So let's jump into some of these. If you have a market you want me to look at real quick on here, I'm not showing you a ton of detailed info on these, please comment below. I'm happy to jump, to look at it. I only have the top 100 metros in this list. So let's start with where some of the carnage was the worst, and that's the dark red. Let me zoom in here to Florida. As you can guess, right? Let's go to Florida. Florida, go down south. So Miami, Florida, between 2007 and 2011, prices dropped 50%. I didn't put a percentage symbol in here into my data wrapper map. I didn't bother, but that means it's down 50%. So home prices dropped 50% in Miami, Florida from 2007 through 2011. Northport, Florida, down 45%. Cape Coral, Florida, that's one of the markets that's actually declining right now, today. I mean, that's down double digits, I think, in the last couple years. But that was down 57% year over year during the GFC. Lakeland, Florida, down 46. Tampa, Florida, they were down 44%. Orlando, Florida, down 50%. And by the way, the links for all these maps that I'm showing today, all these graphs, are in the description for YouTube. If you're watching this on Facebook, you should switch over to YouTube, because that's where you should watch videos. You shouldn't watch them on Facebook. And I can't put links into the Facebook description. It barely shows anybody anyway, my videos, but it'll even be worse if I put links in there. So quite frankly, Facebook is pretty much worthless. But anyway, a lot of friends are on there, so I leave it up. Deltona, Florida, down 47%. Jacksonville, Florida, down 35%. So the major markets in Florida, none of them were really spared. None of them. And what's weird is, so Tampa down 44%. If you just zoom out, you can kind of see, right? The lighter red is less pain, darker red, more pain. So let's kind of travel up, maybe a little bit further north here. Charleston, South Carolina, down 22%. Remember, I only have 100 on this map, so we can cover a lot of these probably tonight. Atlanta, Georgia, down 29%. Well, some of these really surprised me. Like, I don't know. I had it in my head, and this is all based on Zillow data, by the way. That's where I got all this data from, actually their raw data. You can go to Zillow's data center and download all the raw data going on pricing, going all the way back to 1996. Pretty awesome for a housing nerd, right? Let me just, by the way, if you're on, obviously, comment. I want to know what you think about the GFC, and please hit the like button. And I will get to the comments here in a minute. So thank you if you're already commenting. All right. But anyway, I had in my head that all markets went down. Like it was carnage across the board. And also, please comment if you have a story about the GFC. I'd love to hear it. So let's keep going here. Let's look at more carnage, right? Well, let's just stay on the East Coast. What else we got? Raleigh, North Carolina. Let me move this around a little bit. Down 6%. From 2007 through 2011, down 6%. So is that carnage? I don't know. It doesn't seem to be. I mean, it's obviously, I don't want my home value or my investments to go down 6%, but it's not, 100%. Durham, North Carolina, down 5%. Greensboro, North Carolina, down 9%. Winston, North Carolina, down 6%. See, you're learning something about geography. These are all the top metros by size, obviously, population. Columbia, South Carolina, down 4%. Augusta, Georgia, down 3%. Greenville, South Carolina, down 5%. Okay. Knoxville, Tennessee, down 6%. Nashville, Tennessee, down 9%. These are blue, not necessarily meaning they're up. They just have less carnage during the GFC, excuse me. Here's one that everybody's tracking right now. Washington, D.C., down 26% during the GFC. Baltimore, Maryland, down 22%. Philly, down 12%. New York, down 17%. Worcester, Massachusetts. I think I said that right. Down 22%. Took me a second. Providence, Rhode Island, down 22%. Look at this. Scranton, PA, home of Dunder Mifflin, right? 0%, flat from 2007 through 2011. 0% growth. It's flat. Now, remember, in those years, like it could be like 2009, you could actually see price decline, right? It's like Scranton could have been down in one of those years, but it would have been made up for in another year between 2007 and 2011. So, but when you look at the growth rate for all those years combined, 0%. Harrisburg, PA, down 1%. Getting in some interesting information now, folks. Pittsburgh, PA, the Steel City, up 5%. Up 5%. I don't know. I was shocked. I was like, I guess it wasn't like I thought it was. Tell me if this information surprises you. It really surprises me. Rochester, New York down 1%. Buffalo, New York up 5% during the GFC. Now, to be fair, I didn't like, I tried to look at the worst years. Like I did a lot of, I looked at the data and said, all right, well, when was the most pain overall? And it seemed to be between the beginning of 2007 and kind of the end of 2011 overall. So that's why I use those years. So again, Buffalo could have been down like in 2008 or 2009, right? Or 2010 even, or maybe even 2011. But if you look at that whole swath of time, those 4 years, up 5% for Buffalo. I mean, if you go through the GFC and your home value is up 5%, not too bad. Syracuse, New York, up 2%. The Northeast is incredibly resilient with the housing market. Albany, New York, though, that was down 5%. Okay. Well, Boston, what do we got going on with Boston? Where's Boston? What am I doing here? Boston, Massachusetts, down 13%. A lot of major metros, like bigger ones, it seemed like had the most pain. So as far as major metros in the Northeast, that's really where we are. Bridgeport, Connecticut, down 22%. Maybe I said that one. We got Pittsburgh, PA, up 5%. Couldn't believe that. Now let's move into the Midwest a little bit and see what we get. Let me check some comments first. Hang on. My father lost his home during the 2008 GFC. Before he died, he got another $1,200 from the bad loan from Wells Fargo. He got another $1,200 from the bad loan from Wells Fargo. I'm sorry to hear that he lost his home, and I'm sorry to hear he passed away. I don't understand the $1,200 though. You have to help me with that. About $1,200 about. I'm not sure there. You have to clarify that for me, Dan, in the dirt. DJ Forecast. You didn't. I don't think you answered me before. Maybe you did, and I just didn't see it. Are you really a DJ? What a cool job. If you are. If you're not, it's just a cool name. Jason, hello. It's 105 degrees here in San Antonio, Texas today. Holy shnikes. Man, that's hot. What's up, Jay? Bristol County, Massachusetts. Thank you for the information on your videos. You're very welcome. I don't think, so I didn't do this by county, unfortunately. I can go up to Massachusetts real quick and look again for you, but all I have in Massachusetts, I think, let's see. I've got Springfield, Massachusetts, down 10. Worcester, I think I said it right, down 22%. Providence, Rhode Island, down 22%. Hartford, Connecticut, down 15%. Yeah, that's New Haven, Connecticut, down 22% during the GFC. I don't have the county level data. I could probably pull that in, but I didn't do it for tonight's video. So I'll write that down, and maybe that's something I'll do. And you guys got to tell me if you like this info or not, if it's helpful or it's interesting, you know. All right. So let's keep going here. What do we got? Obviously, there's some red there, right? We got some red going on in different markets. But let's do Ohio. I'm in Ohio, so let's cover some areas of Ohio. Columbus, Ohio, the capital, down 11% during the GFC. I was shocked. I was like, wow, okay. I mean, there's going to be pockets inside of these metros where it was much worse and much better, right? That's just how pricing is. But overall, the Columbus metro area down 11%. And I have some graphs to show you here in a few minutes that are like insane, that show you the home price growth for the last 3 decades by city. It's pretty sweet. So stay tuned for that. Cincinnati, Ohio, down 12%. Cleveland, Ohio, down 18%. That's pretty aggressive of a drop in 4 years, right? Akron, Ohio, that's a top 100 metro, by the way, in the U.S., down 12%. As is Toledo, a top metro, down 18%. So there really wasn't an area of Ohio that was spared. I mean, everything basically went down in Ohio. Then we go up a little further north to Detroit, Michigan. Here's some carnage, down 45% in Detroit, Michigan. Home of Axel Foley. Grand Rapids, Michigan, down 18%. So, again, definitely some carnage there and some carnage in Ohio, no doubt. I mean, 11%, is that horrible? Well, it's not fun, especially when your values went up previously, right? And then you take a hit and they go down. That's not fun. If you have to refi, right? You bought before this happened. That's what a lot of people are kind of nervous about right now, right? Buying right now, and they think, what happens if home prices fall and I can't refi in the next 4 years because my value is lower than when I bought it? That's always a risk with real estate. You don't know what's going to happen in the future. But I think, like, if you're buying a flip, you better flip it quick. You should always flip as fast as possible, and you should flip below the median. Flip below the median price in an affordable range, and life should be pretty good normally. And if it's a rental, make sure it cash flows on day one. And then if the value goes down, as long as you're not like over leveraged and you don't have to refi, then you're okay. And if you're buying your primary home, plan to stay in it for a long time. I mean, if you're not going to stay in your house for 5, 10, 15 years, at least 5, like, maybe it's not something you should be buying. I'm not saying don't buy, just saying think about that. Louisville, Kentucky, down 6%. Indianapolis, Indiana, down 7%. Chicago, Illinois, down 29%. That's a big drop. But again, like, and I'll keep moving here further west, but like, look, if you just zoom out on the map, all the pain is like in the spots where you would assume the pain would be, except Texas. Texas actually fared pretty well. But Florida, then out here, right? We'll get to that in a minute. Out west, that took a lot of hits, obviously. So there were like these superstars of the crash, I think, that are embedded in people's brains that make them think everything went down 50%. Like the comments on my channel are like, when they talk about home prices dropping, people are like, they need to drop 50% at least. And I'm like, well, according to the map that I'm looking at, there aren't a lot of markets that went down 50%. There are some, and I'm not saying they can't go down 50%, but they aren't, or they didn't go down, or most metros didn't go down 50% during the GFC. So you just got to have the right expectations, right? Minneapolis, Minnesota. This surprised me. I actually know some people that lost their home in Minneapolis during the GFC. So it surprises me that it was that, that the markets around it weren't going down as much, but Minneapolis down 25%. I think a lot of this has to do with new construction. I remember during that period of time, I went out there I was in the construction business, not building homes, but in a different industry inside of construction. And I remember seeing the homes out there and I was like, wow, there's a lot of new construction in Minneapolis. But Columbus, not a lot of new construction. I guess not in Pittsburgh either, because prices went up. Des Moines, Iowa, down 8%. Kansas City, Missouri, down 8%. Wichita, Kansas, up 2%. Tulsa, Oklahoma, down 1%. Oklahoma City, Oklahoma, up 2%. So let's get to Dallas. Little Rock, Arkansas, down 1%. Look at Dallas, Texas. I mean, definitely down, right? Let me zoom in. Sorry, guys. Definitely down 7%. But not like, it's not down double digits. Austin, only down 5%. Now their crash is much worse. Easily double digits. I think it's maybe around 20% or more off the top of my head recently from the peak of what they've seen. San Antonio, speaking of DJ forecast. Hey, by the way, DJ, did you ever sell your condo? I'd like to know. I think you were selling a condo, right? Or townhome, not a condo, townhome. San Antonio, Texas, down 3%. Houston, Texas, down 5%. We're going to look at more detail here in a minute on some of these. El Paso, Texas, down 3%. Albuquerque, down 12%. Denver, Colorado, a lot of people think that's going to crash hard right now. Down 10%. Colorado Springs, down 9%. So, yeah, definitely some carnage and some loss in a lot of these areas, but it's not like, you know, it's not like it's the end of it was the end of the world in some of these markets. However, when you go out west, that's when the pain really starts. So like Salt Lake City down 16%, Provo, Utah down 18%, Phoenix, Arizona. Like again, I think this is in people's brains that, hey, all the markets crash 50%. No market's going to be spared if there's a housing market downturn. Well, Phoenix crashed 52%. That's one of the higher ones we've seen so far, though. We've covered a lot of these, a lot of metros so far. Down 33% is Tucson, Arizona. Riverside, California. I was out in California. I lived in California during this period of time. I didn't own a home. I was in the construction business, and I lived actually in Orange County, and it was insane, the building in Riverside, California. The building of new homes was like off the chart. And I'm not surprised to see home prices went down 50% during that period of time, 2007 through 2011. This one surprised. Let me go down to San Diego. San Diego, California, down 32%. That's a lot, right? Los Angeles, California, down 34%. Oxnard, California, that's its own metro, down 34%. Fresno, down 48%. They took a beating. San Jose, I'm shocked, down 28%. Definitely down, but not like Riverside, 50%, right? San Francisco down 28%. Sacramento down 43%. That's one of the bigger ones as far as the drop. This may be the highest drop so far. Stockton, California, tons of new building out there at that period of time. Down 60%. Boise City, Idaho, down 34%. Portland, Oregon, down 23%. Seattle, Washington, down 27%. So, what do you take from this map? I'd like to know. I'd love to hear your input. I'll get to the comments here in a minute, but when I zoom out, I'm like, wow. Oh, look, I forgot this one. Honolulu, urban Honolulu, Hawaii, down 9%. That's it. I mean, listen, I don't want anybody to lose value on their home, but still, I was like, oh, it's going to be down like 90%. So like, is the biggest one, what's the biggest one? I think it's Stockton. I think it's Stockton. And this is the top 100 metros. Remember that. There's probably metros that are smaller that fell further. But it doesn't matter why. I couldn't put them on the map. It's a data wrapper issue that I'm not skilled enough to figure out yet. So I'm going to have to call Lance Lambert and have him help me. So if you're listening, Lance, I'm going to call you for some data wrapper help. But I thought this was interesting how like you can really see the carnage, right, in like regions. What will happen this time? Well, the map's going to look different because now Texas is down certainly more than it was, you know, in some areas more than it is or it was during the GFC, sorry. And but other areas like Minneapolis and Chicago and Detroit, they're not down at all right now, hardly. I don't think any of those are down. They're all up a lot. I mean, Detroit definitely. So, you know, the map's going to look different in the next crash or the next downturn, whatever happens. But I don't know. I thought this was interesting. So I'll leave that up for a minute, and then I'm going to show you the next thing. All right, let's look. Let me go back. So, oh, I got Bristol County in here. Sorry. I don't have Bristol County on there, but you saw what I could do. Lawsuit money about, sorry, autocorrect. Oh, he filed a lawsuit and he got $1,200. That's it? I'm sorry to hear that. Hi, can you check out Chattanooga? Well, unfortunately, I don't have that granular of data in here. I apologize. But if you tune into my Redfin update, I'll do it. By the way, thank you, Roman, for joining us. It'll either be Thursday or Friday. I'll do a Redfin update. I try to do them live. If I can't do them live, it'll be a recorded video that maybe it doesn't get published till Friday late or Saturday. But I will write down Chattanooga and I'll analyze that one. Not from a crash standpoint, but more of a current market standpoint. And I'll do Bristol County as well. All right. And that'll be on the Redfin update that I do here in a few days. Curious if this pattern also followed job gains and losses. Yeah, like it would be good to see that information. One of the problems with what I use here, this data wrapper program, it has a lot of good advantages, but man, it would be great if I could click the map and actually make the changes in the map and show like job loss, inventory gains, different aspects, and have them brought into the market and overlaid on the map. I can't do that in this program, but I am working on a visualization that I can do, like a job gain or job loss. Retired DJ and military. Sweet. Thank you for your service, sir. McKean County, Pennsylvania. Wasn't that, isn't McKean County Pittsburgh? Maybe it's not. Oh, Tucson, Arizona. Well, I'm feeling generous. I mean, you can go back and rewind the video, but here it is. Tucson, Arizona, down 33% for you. During the GFC from 2007 through 2011, there could have been other years where it went up or down, but hang on to that thought because I'm going to show you some more data here in a minute. If the Fed cuts rates, prices will go back up. Well, I don't know if the Fed cuts rates, because the last time the Fed cut rates, the mortgage rates actually went up. If that's what you're referring to, mortgage rates. But I get your point. If the 10-year Treasury drops and mortgage rates drop, then yeah, I think prices will rebound. They could rebound in many markets if the 10-year Treasury drops enough and drops mortgage rates enough. And I have no doubt in my brain that that is what the folks in Washington want. They want a lower 10-year Treasury. Why? Well, they want lower interest rates from the Fed because they want lower deficit payments, but they certainly want a lower 10-year Treasury because they want assets to be able to be purchased at lower debt rates. They also probably want to refi some of their debt. I mean, the people that are in charge are real estate moguls. So they probably want the 10-year to be lower. Just a hunch. I agree with you, though. Appreciate your work. You're welcome, Jay. What kind of car is that? What do you got there? I can't tell what kind of car that is. I'm an old man. I'm like squinting, doing the old man thing. I can't tell what kind of car that is, but it looks like a cool car. Townhome is still on the market, 25 days in only one showing. Price started at $205,000. Now have it at $199. About to drop it to $198 soon, which was purchase price. Dang, man, I'm sorry to hear that. I'm sorry to hear that. Shoot. Well, I mean, I probably already asked you this, but can you rent it out? Maybe you don't want to do that. Maybe you definitely want to sell it. I'm not saying, I don't know your situation, but I feel bad for you, dude. Dang it. And unfortunately, there's really, if you're not getting any showings, it's because of the price. I mean, I hate to tell you that, but that's what it is. People aren't, they're going to look at it and go, well, there's either other ones that are lower, or, maybe it's the HOA or the town or the association fee or something. But yeah, not a lot you can do except drop the price. Is there an option just to keep it? Can you just stay put? Maybe you don't want to, maybe you can't. Do you have a low interest rate? Well, it's the question is, one of the question is, do you have a low interest rate? If so, is it assumable? If maybe it's a VA loan. I don't know if you used a VA loan or not, but if you did, it could be assumable. Are you advertising that it's assumable? Just some curiosity there. I'm praying that doesn't happen. Oh, you're talking about prices going back up. Yeah. I mean, it wouldn't be healthy for the market. It really wouldn't be. The last thing in the world we want is cheaper money that will spur more growth. We don't want that. Investing in Beanie Babies. I hear they're making a comeback. Huh. I don't know about that. But I mean, isn't that how Gary Vaynerchuk got his start? Beanie Babies or stuffed animals or something? I don't know. What else we got here? But Daniel, thank you for joining us. The VHS market has been making gains. Hey man, that legacy media is valuable. I get it though. I think it will be in June, unfortunately. What? Oh, you guys are having a conversation. Sorry. Let me keep going. Okay, check this out. Tell me what you think about this. So let me do another map here, and then I'll go to these charts. Now this is crazy. This is the post-GFC home value change. Maybe that title's not great, but this is from 2012 through the latest data of April 2025 home value by metro. Same metros we just looked at, but this is after the GFC and what happened to home values. Some of this isn't surprising. Some of it's like, what? Blue, insane prices. Red, price gains, but not as high. But nothing dropped, as you can guess, in the top 100s. So let's start. I'm not going to go through all the metros like I did on the GFC drops, the price drops. But Miami, Florida. Let's go into Miami. Let's go into Florida for a second. 224% from 2012 through the latest data in 2025. 224%. Wow. Orlando, 205%. Lakeland, Florida, 207. Tampa, 206. Palm Bay, Florida, 200. Here's one lower, 156%, Jacksonville, Florida. But like probably the one that's the, well, let me look here. Little Rock, Arkansas, 53% gain in prices. New Orleans, Louisiana had the smallest growth. Look at this. Since 2012, for nearly, 13 years, home values went up 26%. So that's like, what? Dumb math is like a little over 2% a year. Is that right? Yeah. So like, that's just like, I guess, inflation growth over the past 13 years or something. Not that much. 43%, Baton Rouge, Louisiana. Little Rock, Arkansas, 53%. Let's go to the East Coast real quick and look at some of these. Albany, New York, 71%. Springfield, Massachusetts, 86%. Hartford, Connecticut, up 75%. New York, up 84%. Baltimore, Maryland, up 66%. Washington, D.C., up 79%. We'll do Ohio real quick. Columbus, Ohio, up 139%. Cleveland, Ohio, up 102%. Cincinnati, Ohio, up 114%. And a lot of these gains in these markets obviously happened between 2020, I'm sorry, between 2019 and 2024. I'm guessing a lot of these gains. But St. Louis, Missouri, up 84%. Wichita, Kansas, up 89%. Something I kind of noticed, though, was where the price gains have been the smallest or the most kind of in check are where they didn't go down as much during the GFC versus Florida and out west, where prices have exploded exponentially, even more so than like 100%. And the price losses were huge too. Look at Phoenix, Arizona, 208%. Mr. Tucson. Actually, my grandparents used to live in Tucson. I've been to old Tucson many times. I'm not sure it still exists, but it was always a fun thing as a kid. Tucson, Arizona, 136% growth. Riverside, California, they're back at it. 214% growth in home values since 2012. I mean, again, it's like all these metros where the prices drop the most are the ones where they've gone up the most recently. A lot of them, like look at Boise City. This may be the biggest, folks. 242%. What? You know what's interesting is, look at this. San Antonio, 99%. Austin, 124%. But a lot of that is because, or there is a drop there because prices have dropped since 2022 in some markets, including Austin. Houston, 114%. Fresno, 173%. San Jose, 209%. Stockton, that was the biggest drop during the GFC. That's been up since 2012. They've gained 229% in home value. Just nuts. Yeah, I mean, Boise City may be the highest at 242. What's Detroit? 207. And Detroit was down 45%, I think. Right? So if I go back to this, right? This is the value changes during 2007 through 2011. Look at Riverside down 50%, Boise City down 34%, Detroit down 45%, Stockton, right, down 60%. I think this was the biggest drop. And then if we go to the price, since the GFC, what prices have done, you can see the ones that have gone up the most are the ones that dropped. Sacramento, 175. San Francisco, 159. Seattle, 187. More of the story is, like, about every metro went up, obviously, but some just went, like, parabolic, through the roof. So is that where home prices are going to decline the most in the next downturn? I don't know, but that's kind of like, I saw that and was like, that's kind of interesting, to say the least. Atlanta, Georgia, 194%. To somebody's point, it would be interesting to overlay the not only job loss data, but it would be interesting to overlay the not only inventory, but also investor activity. Where are the investors buying the most? I know they buy a ton in Atlanta, for instance, right? We know that they bought a ton in Florida. So, and obviously out in Riverside, Phoenix, Las Vegas, and also, the work from home thing. How much did that contribute to it? I just can't overlay that data at the same time. There's probably a program I can use or a website I can use, another subscription, right? This is free, by the way. Data Wrapper is free. To put the data in here and look at this, free. But it'd be nice to have some type of toggle button. They just don't have it for Data Wrapper. Could probably do it in Excel, but I probably have to hire a VA for that because I'm not going to monkey with coding that. Anyway, I thought this was interesting as well, this post GFC stuff. So I'm going to show you this. I'll give you a peek at this, and then we'll jump to some inventory information. But this is pretty awesome. So it's, again, using Data Wrapper, and like in San Francisco, this maps, for instance, the last 3 decades of home prices in San Francisco. And the cool thing is you can have 2 of these side by side to actually see how they kind of changed at the same time, right? Or like what happened to values. But San Francisco, for instance, started at $208,000 back in 1996. A year after I graduated high school. 208 grand for a house in San Francisco. Then it like peaked during the GFC, or right before the GFC. It peaked at 670 grand, and then it dropped to 437,000, and then rode that wave all the way back up to $1 million, obviously. And it's just staying at 1 million. It's not giving me the minute change in that because it's rounding. But you can see it did peak. And what I want to show you here is a lot of these metros peaked back in 22, and then they've dropped since then. Some have eclipsed the peak, or eclipsed 2022, but some haven't. So is that a crash? I don't know. I mean, it's hard for me to tell on this graph. We'll have to look at another city. But that's what I want to show you guys. But before we do that, let's look at inventory, because this is where the rubber meets the road, I think. One of the biggest annoyances of real estate data is that it's virtually impossible, except here in Columbus using the MLS, to get historical inventory data going back before like 2010. Very difficult to get. National Association of Realtors like removed it from their data sets. Maybe you can pay them to do it. I'm not going to pay them to get that data. But there are companies out there who have captured that data in the past and have kept it, and they put out charts. And if you take those charts and then put them into a AI software, you can actually extract the values and create your own chart. And that's how I did this. See how much I'm working for this channel? Look at that. But this shows you the number of homes for sale back going all the way to 2000. That's the earliest data I can find, pretty much. The blue line is existing homes. This black line are new homes. And what you need to look at is the growth and the peak of inventory. Supply and demand, folks. Supply and demand. Well, you can see existing homes, the inventory of homes for sale, back in 2000 was 1.9 million existing homes, and we had 300,000 new homes for sale. And then look what happened. We climbed to a high of about 500,000 new homes for sale and a peak of about 3.6 million existing homes. You add those together and you get just over 4 million homes. So in the peak of carnage, 2008, we had basically 4.1, in some accounts even higher, homes for sale on the market. I mean, that's crazy. And obviously it dropped and dropped and dropped and dropped and dropped and dropped. 2021, we had 1.1 million. This data set will vary depending on which source you pull it from. So I don't take it for gospel, but I did my best to pull the data. And now we're at 1.33 million, it says, and about 500,000 new homes for sale. So like, and by the way, one of the reasons why it says 1.1 million back in 2021, even though some accounts we only had like 400,000 homes for sale, is because some data sets will count pending homes. I'm sorry, contingent homes that are in contract as actually active listings. So I think the point though is to look at this and go, geez, we have not near the inventory that we had back during the GFC. I mean, it's plain as day. We just had a lot more inventory. Now, I don't have this data, unfortunately, by metro. I can't find it anywhere. So if you're out there and you know how to find that info, I'd love to see it. I'd even be willing to pay for it if it was reasonable. But I cannot find inventory levels by metro going back to the GFC. That's what I want, going all the way back to 2000 to look at how inventory changed in certain markets. I can do it for Columbus because I have the MLS because I'm a realtor, but I can't do it in other metros. Even Lance Lambert, his data from Resi Club Analytics, that won't show me either. It only goes back to like 2016 or something. Anyway, I thought this was pretty interesting. How many homes we have for sale. So we're not even at the level of existing homes that we were back in 2000. Like, people were like, I've heard people say we only need like 100 more thousand listings and like real estate nirvana will like rain on us. Okay. I mean, that would still be like a really low level of inventory though. And if you remember right, before COVID, like around this time, inventory was actually dropping. Inventory was going down right before COVID. And guess what? Prices were going up before COVID. So I think we need to do a lot better than what we did right before COVID. Everybody has that mark, right? We have 19% fewer listings than we did pre-COVID. Okay, but pre-COVID, I was flipping homes. They sold within like 20, 25, 30 days. They sold. It wasn't like 5 days, but they all sold. There wasn't a housing glut of inventory. So just to get back to COVID ain't going to work, in my opinion. Especially now, because most homes on the market are like that are sitting there a long time are homes people don't want or can't afford. They're not like affordable homes. But look at this. Look at the new homes. And these are completed homes, like ready to be sold, like in inventory, right? And I know there's a whole narrative out there about shadow, zombie, boogeyman homes. I get all that, but they've always had that. It's nothing new. It's just Facebook and YouTube is new. So that's why you know about it now. But home builders were always doing that. So if you look back, we had like 500,000 new homes. Then it dropped all the way down to like 150,000 homes. Not that many. And it's continued to go up, and it really hasn't gone down that much. You know, we're back to nearly GFC levels, almost GFC levels with new homes that are finished. The trick is that if you combine that with all the existing homes, that's where all the carnage happened. It is. And there's probably a lot of homes in here that's not reported, so that probably contributed to it as well. But I thought this graph here was kind of interesting. Now we'll go to this next, but I'll take some comments. Don't have nothing to say. That's not. Let me look. Oh, you guys are talking about your HOA. Got it. I think these are the ones that will decline. They already have a lot of inventory. Oh, the markets that have gone up the most? Is that what you mean, SC? Are you from Southern California or South Carolina? I don't know. But yeah, you could be right. Crazy inflation. It is. It's like, and if you really think about it, well, let's look. Here, let me show you. Let's look at Riverside. Look at this. Look at this chart from Riverside, California. Homes in 1996 in Riverside, California were $118,000. Not too bad. They went up, and I mean straight up, like a roller coaster, right? Straight up. 398 grand. People then were probably like, I can't believe people were paying 398 grand for a house. Now people would like, you know, they would like run through a brick wall to like get that price in Riverside. And to TM's point, like that inflation was nuts, right? And then the bottom fell out and it went all the way down to 183 grand. So like that's in 2012, meaning if you bought, you know, anytime after 2002 in Riverside, it took you longer, right, than 2012 to get back to your home value. But look at it go up and up and up, and then it went straight up from like 2020 through 2022. Now 581 grand. See, it went 581 grand, then it went down 541, but then went back up now. And then obviously because you know, recently we've had more inventory in places like Riverside. You're starting to see some of that price decline. But like to see a price decline like we did during the GFC, not saying it's not possible, but there's a lot of falling that would have to be done in order for that to happen. I mean, it peaked at 593, according to Zillow data. Look at Miami, Florida. Peaked at 310. You could buy a home in Miami, Florida for 102 grand back in 1996. 310, it peaked during the GFC. That's a peak. Huh. Then down to 149. Then all the way back up to 493. See if I can go in anymore. That's about as far as I can zoom. Let's look at Boston. Somebody asked about Massachusetts. Boston. And the interesting part is also look at the seasonality. Because this is by month. It's not showing you the month on here. I apologize. It's just showing you the year, but this is by month or quarter. This may be by quarter. Maybe that's how I ran it by quarter. Where the ups and downs are. But in Boston, Massachusetts in 1996, you could buy a home for $156,000. 412,000 is where it peaked during the GFC, and then it fell all the way to 312. Didn't actually fall that far, right? And then it went up to 658 in 2022, and it's kept going. 717, now 706, but it's probably going to peak again this summer, this spring, right? Let's look at a market that didn't go down, though. Let me look at, well, some of these are hard not to look at because they're just crazy insane. Look at Bakersfield. That's nuts. I mean, look at Columbus. Why this isn't, well, there's the United States. I should probably look at that too. Why I don't have these organized alphabetically, I don't know. Sorry. You can't search either on here on the screen. Oh, there's Tucson. Let's do Tucson. Somebody asked about Tucson. Look at Tucson, 110 grand. Wow, just like Boston or near it. And then it peaked 244. Then it dropped through the bottom, $136,000. Then it peaked at 356. See? And you got back to the peak kind of recently. And now it's off peak a little bit. Let me go back. I'm just looking for, here's Columbus. So look at Columbus, Ohio. Like, started out at 108. Everything's 100 grand back then. All the markets were $100,000. Huh. You'd have your pick. Now people are like, I'll take 3, please, at 100 grand. All right, so $162,000 in 2006. Wow, that was our peak during the GFC. Scary. Then fell to 132 in 2012. And see, I ran that data before from 2007 through 2011. So this is an outlier from that. It would have been down more if I'd expanded that date range. But did I do 2011 or 2012? Shoot, I can't remember. Let me see. 2011. So yeah. And look, we, in 2022, Columbus, all the way at 304. And now we keep going 324, 325. Now we're back at 320. We'll probably hit another peak this summer, I'm guessing. But yeah, a lot of these charts aren't near as dramatic as some of the other ones, right? Where prices went through the roof. Like, look at Pittsburgh. This is a market where prices actually went up during the GFC, not down overall. So they started out at 75 grand. You can buy a home in Pittsburgh, PA back in 1996 for $75,000 before the Steelers had those 2 Super Bowl wins. And then 2010, 127, it kind of bobbed up and down, but it didn't crash by any means. And then it went up, but it didn't go up like, I mean, it's certainly more expensive, 202,000, 204, 222 now. Not, you know, it's not the gain that you see in some other areas, no doubt. But some of the other, I mean, people look at Pittsburgh and they go, well, it's not Las Vegas. That's not Phoenix. I don't want to live there. So it is what it is. Even Houston, like, look at Houston's, didn't drop that much during the GFC. It did go straight up, though, recently, right? A lot of migration there. Look at Detroit. This is a crazy one. Maybe one of the crazier housing markets in the U.S., folks. $90,000 in 1996. And then it peaked at 159 grand and the bottom fell out. And it went all the way down to 82 grand. This may be one of the markets, there are probably a couple others we can find, but home prices in 2011 in Detroit, Michigan were actually lower than they were in 1996. Wow. Now, we're only talking a few $1,000 bucks, right? like 80K compared to 90K, 10 grand. So it's still a drop, but it's like, you know, you can't buy a car for that now, the difference, right? But then it went up and up and up and up, and it hasn't stopped. Maybe one of the reasons why it's gone up so much is because the houses there are affordable. Maybe that's why. Well, affordable to people who don't live there, but people who, like the people that are born and raised in Detroit, are priced out, a lot of them. They comment on my channel. I feel bad for them. Look at Austin. Look at that chart. Yikes. 96, $159,000. 2012, $192,000. So again, they didn't drop that much. Like the peak was 210, right? 213, then 193,000. But then look what happened. Austin became like hip, right? Is that what happened? Maybe. COVID happened too, right? When did it really start? Yeah, look at COVID. COVID hit and boom, it went directly straight up. Like from 2019 through 2021, home prices went from 327 to 491 in just like a year. Literally 1 year, it went straight up. Then it was like, well, I'll take a break. Just kidding. Going to go up more to 579. And look, now it's fallen all the way down to 447. So like this growth here through, 2012 through 2019 probably wasn't, a huge amount of speculation. It was probably the city becoming a fun place to live and migration and natural home prices going up. I'll bet they went up fast. But then what was unnatural is COVID and people going, hey, I can buy a house in Austin and work there instead of, Houston or Riverside or Seattle or New York, right? And they're like, man, a home in Austin, Texas is only $327,000. Sure, I'll buy one. And people kept buying them. And then people wanted the Airbnb thing, right? I'm going to have a cool, hip Airbnb. Oops. I should have put Austin. I should have had Austin showing there. People knew what I was talking about. But Austin, crazy, right? I'll do one more and take some more comments. Tell me if there's a metro I should look at doing this. Got the top 100 just like we looked at before. That's all I have is top 100. There's San Antonio, right? Started at 105, 150,000, dropped to 137, so 13,000 bucks. And it has gone up fast, right? It has. Now then 308, now down to 281. I mean, nothing's been spared from the run up, no doubt. But like, remember we looked at New Orleans? It's gone up 24% in the last, what, 10 years? Is that right? 13 years? $91,000 back in 1996. 216 at the height at the GFC height of prices. Then it fell down to 190 and it's gone up. It certainly has. And it peaked in 2022 where a lot of these peaked. Can you even see me? Is it completely dark? No, it's not dark yet. But now it's dropped. Look at that drop all the way down to 236. So places like New Orleans have certainly taken a beating over the last couple of years. Will it continue to fall like it did during the GFC? I mean, it could, but there's other factors, though, that aren't in play right now that were beating us to death during the GFC. There's Chicago. Yeah, Detroit may have been the worst, like, graph. I'm curious about. There's Baton Rouge. Sorry. Let me just look it up real quick and see if I can see Durham, Tucson, Cape Coral. Yeah, look at Cape Coral, Florida. What? $115,000. I mean, it's like a roller coaster there. And this is what I think a lot of people have in their brain with the GFC. This is how it happened, right? Prices went up straight up, $325,000. Probably a lot of investors, probably a lot of second homeowners, I would think. You could buy. I mean, that's a major difference between now and then. Major difference is back then you could do LTV of 100% sometimes. You had no skin in the game, no down payment. I don't know of a loan right now where you can go 0%, like 0% down. there has to be some type of wedge there or equity. So that's the difference between the GFC and now. But 323, then it went all the way down to 131, which is still higher than 1996. So Detroit has this beat from a doomsday, I guess, but $131,000 in 2011. And then it started going up because of, natural housing market going up, but then straight up again because of free money, and work from home, 415,000. Now it's dropped to 366. So that's headed for $100,000 price change. But I think this graph is what a lot of people think in their head when they look at the GFC. They go, see, this is what's going to happen. Well, in a few markets that happened, but not all markets did that. Look at Vegas, another one that's goofy. Up, started 138 grand, 330, and then the bottom fell out. It fell out, and then it was like, nope, we're not done. We're going to fall out more. $122,000 all the way up to 438. It dropped, but then it went back up, and now it's going sideways. So I don't know. Maybe the market, maybe the price correction is done there. Who knows? Let me look at some comments. And can you see me? I'm going to turn on the light. And this light is not good, but it is what it is. It's not my studio light. I don't have a studio light out here, but I usually don't do evening lives, but this is kind of fun. I pray every day that Middle Tennessee comes back to normal for 3-bed, 2-bath house that isn't a look and size of a shoebox. You want the size of a shoebox, or I don't understand exactly what the end means, but I understand. It's not fun trying to find a house that is affordable. Are you looking for a small house, or you don't want a small house? And thank you, Kyle, for joining us. Kyle Rooney. TM, 3 differences from now and GFC. BlackRock, illegals, moratoriums. Okay. Yeah, I mean, I understand your point. Institutional investors, migration, I understand all that. Moratoriums, I certainly understand that. With kicking the can down the road, you're right. Those are definite differences. But you also have to remember that adjustable rate mortgages made up like 45% of originations. 45%. Would it surprise you to know, however, that we are now at like 15% of originations are ARMs, adjustable rate mortgages? Yeah. So, is there a danger that rates are going to go much higher than we are right now? Maybe not. Maybe so. But ARMs are kind of making a comeback because it offers you a cheaper rate up front. I would seriously reconsider if you're going to get an ARM loan, though, on a primary home. If it's an investment property, I'd still caution you, because I've gotten whacked on those. But your point is valid, that there are things that we didn't have during the GFC that we do have now. And there are things we have now that we didn't have during the GFC. Is that how you say it? I don't know. But you get my point. Also, think about the fact that you also have, I think now real estate is more hip, right? The investing part is more hip. And that was all exposed after the GFC. So a bunch of investors, small like me, medium size, and huge investors rolled into the housing market and bought up a bunch of inventory. So that happened too. And we haven't seen a crash since then. We just saw a bunch of free money and the prices just kept going up. Hey, if you're on here and joining us, welcome, by the way, tonight. And please hit the like button. Don't be a freeloader. What else? What other differences do you see between now and the GFC? I mean, there's a lot of differences in the economy, and those are fine if you want to mention them. COVID really screwed us. We should sue the Chinese government. Hey, good luck with that. Good luck with that, DJ. I mean, I remember when COVID hit, I was in real estate and we were an essential business. Not saying we weren't essential, but things did not stop at all for realtors, or investors. Like nothing stopped. In fact, it was a great time to go out and look at properties because there was no one on the road. So I was out every day looking at properties because I was like, man, this is, and people, you had to be really cautious around homeowners. But COVID, it was scary at first because everybody in the investing community thought, oh no, prices are going to drop because of job loss, right? And people thought that there were going to be like the sale of the century, but the opposite obviously happened, and things just went completely nuts. Completely nuts. COVID happened to prevent the crash. Man, I mean, there are a lot of other ways to prevent the crash. They could just print more money, which they ended up doing anyway. We're about to crash end of 2019. We are about to crash end of 2019. I don't know what that means. 1996 was great pricing. Yeah, it was. I mean, go back to this, right? Like, not to make us sick or anything, but it's good to look at the facts. Look at a major market. Nobody wants to buy in these cities. I'm just kidding. But some people don't. Give me a Memphis, Chicago, Akron, Little Rock, Wichita, El Paso. These are all small metros. Sorry, folks. Let's look at San Diego. Yeah, look at San Diego, 166 grand. To DJ's point, DJ Forecast point. Look at that, 166 grand back in 1996 in San Diego. Zoinks. And they rode that wave up to 552, and it fell to 335. And again, like home price growth that you would see probably after a big downturn, right? You're going to see home prices go back up. Then they went up really fast, all the way to 915. Then down for a second in 2022. A lot of metros dropped value in 2022, and then they went way back up to 969 grand. So I was really paying attention to the housing market, obviously in 2022, as everybody was. But one of the folks that I got to give a shout out to, is Travis at Real Estate Mindset, because I clearly remember I was flipping a home. No, I was working on a rental property, and I was like, I don't know, painting or something. I don't know what I was doing. And I was listening to him on his live. And I remember the day that the bank term funding program was put into effect in early 2023. I think it was in March. And I felt bad for the guy. Like, he was on a tear with his prediction because he predicted that home prices were going to start to fall in 2022. And they did in a lot of markets. They started to fall. I mean, I guess I would consider myself more of a bullish person, but more so than he is. He's like a perma bear. Like, he's like, you got to wait 30 minutes before you go in the water after you eat type guy, right? Which is fine. But he predicted that crash and that downward trend. And then when that bank term funding program went into effect, I remember that morning when he did his live, and he was dejected. And so you could really see that liquidity pumped into the system. You can see how it changed, especially the West Coast. It changed a lot of metros and didn't make them, but it gave some hope to the housing market and kind of rebounded back up. Now, that's probably not the only factor, but there was no doubt that we were headed down in 2022. So that shows you what bailing out does, what printing money does. It'll be really interesting to see what the current leader of the U.S. does with printing money. It's going to be really interesting to see. I mean, it's theater, it's entertainment that you're not going to be able to buy. It's going to be amazing to see what happens. Either way, not to print or print. Anyway, that's what I think about that. But you're right. Pricing was great in 1996. That was the point of all that ramble. You're going to make it big with your channel. Great job. Wow, thanks. That means a lot. YouTube's weird. By the way, I encourage anybody who has a hobby, or even if you like real estate or whatever you like, to get involved in, to do a channel on YouTube. You learn a lot about yourself, and it's not easy, but it's fun though. At least it is for me. Las Vegas. Well, we just did Las Vegas, kinda, right? But did you see that? I don't know how old this comment is. Let me go back to Vegas. Boy, this is like maddening for me to look through this thing. I don't even know where it is in here. It's probably not down here. Charlotte, blah, blah, blah. Oh, there we go. There's Las Vegas. We need a search function on here. They don't have one. $138,000, 1996. Then up to 337. Then down to 122. Then up to 430. I actually know some folks that bought a condo in the MGM Grand. Like the new one, like they had there was a tower they built. I don't remember the name of it. I think it's changed hands now. I think it's a Marriott now. But you could buy a condo in there. And they bought a condo in the MGM Grand, thinking that they were like Mr. Trump or something, I guess. And then that didn't work out. And it was foreclosed on, I believe. All the way down to $121,000 for homes then. So that's like Detroit. Detroit dropped below the starting point on prices in 96. So did Vegas. $121,000 back in 96, 138 grand. So I guess, that's a good warning sign. If you're in a market where the graph looks like this, where it's like, woo, 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 look really closely at the inventory before you buy. You need to look at inventory anyway before you buy. But if you're in a market that's like a roller coaster like this, very severe, watch that inventory and plan for the worst. If you're going to buy, just plan for the worst. Know that you're going to be in the home for a while, probably. And make sure you're okay with that. Make sure you can afford it today. Forget that marry the house, date the rate monkey business. It's the worst advice anybody's ever uttered for real estate. Buy comfortably now. And make sure you have a slush fund and a slush fund backing up that slush fund. And then money buried in the backyard with your third slush fund, just in case the zombies come, right? Because you never know. You never know. Sometimes you do. Resi Club just post this. Posted what? This information here? I didn't know they posted this. Look at that. Why is my screen like that? Oh, let me see. Maybe that's a little easier to look at. $1,500 square foot house that isn't the shape of a rectangle or square. Now, I get it. At least you're not after a huge house. So on my channel, there are videos about how to find an off-market property. I'll tell you and caution you, they were very early videos when I was more like goofing around in a way. And they're not great. they're maybe not the best videos in the world. So I am in the process of redoing them with much better, they're just going to be much better. But they are tutorials on how I find off-market properties. So you may want to check those out. Maybe they'll help. Yeah, we should talk more about that on the Redfin Live or the next live I do. If you want to join us, Kyle, and ask some more questions. If you're struggling trying to find something out there, there are ways to find off-market properties that not many people are willing to embark on. But I commend you for not looking for like a 3,000 square foot house, right? You're looking for a basic house, but you don't want it in a square. I understand. Let me ask you, would you take a square? Right? I don't have a square to spare. Would you take a square? Because a lot of the homes the boomers grew up in were not like big homes. Like the house I grew up in was like 900 square feet. It was a square, right? Had one bathroom, 2 bedrooms, no air conditioning. If you're willing to take something like that, maybe there's an opportunity out there, and then you just put some sweat equity into it over the years. Or maybe you've already thought of that. Would you please do South Carolina market? Okay. Well, let's see. Boy, you guys are going to make me go back and search through this. You guys are probably telling me there's a way to search, Jason. Oops. I got a bug zapper out here now. I just found a bug. Greenville, South Carolina. There you go. 101,000 back in 1996. 148,000 in 2008. 135,000 in 2012. So it didn't drop that much in Greenville, South Carolina. And then it went all the way up. Again, look at you. I mean, COVID is plain as day in most of these markets. In the markets where there are either really cheap homes or markets where people like would want to buy a second property, right? Like a vacation home or something, or an Airbnb. You can see here, COVID just straight through the roof, right? Like in 2020, you were at 204. Then 2022, 289. So a couple years, it went up $90,000. Man, yeah. You look at this, it's really eye-opening. You really hope and pray, like somebody already said, this doesn't happen again. But hoping doesn't really work that well, right? So it could. 104. Okay, Columbia, South Carolina, 94,000 back in 1996. 147,000, 2008. 131,000, 2013. So like Columbia, South Carolina didn't really bottom until 2013. Okay. Then 156,000, and then it went straight up, but nothing like Greenville did, right? Is that where we were just now? Yeah, right? Or Charleston. We were in Charleston. 237,000 in 2022, but it's gone up from there. Now 251. That's a market that hasn't slowed down at all with prices. Same with St. Louis. Look at St. Louis right next to it. Kind of interesting to look at them side by side, right? How Columbia, South Carolina did. You can't sort these manually, by the way. Like I can't move these around. I'd love to do that, to be able to put like Los Angeles next to Columbus, Ohio, just for fun. Can't do that unless I removed all the data except those two cities. 137 was a bottom, right? Yeah, 137 in 2012. 2007, 168 grand. And it started out at 95,000. And then it didn't. So like St. Louis, it did go up rapidly. I'm not saying it didn't, but it wasn't like that climb straight up and down like you see in those other markets. I'm like straight up and down this way. Yeah. Even Chicago, right? Look at Chicago. It did go up rapidly, but it's going to continue to go up. The trajectory wasn't straight up and down. And that tells me that maybe a lot of that will keep that market steady, perhaps, because that market is really tight right now. There's a few viewers on my channel, and they struggle big time in Chicago. They can't find anything still. Man, I could look at that data all day. Sorry. Get lost in it. All right, I've got time for a couple more minutes. And then I got to roll. TM, we might have to resort to 50-year mortgages. Most people are only concerned about monthly payment costs, not price. I agree 100%. There's a group of people out there that are conscientious about the price. I did a poll on my channel. I don't remember what the percentage was, but the vast majority of y'all wanted lower prices. You didn't care about rates. And I understand that, but that's not how consumers buy. It's just not. And no matter how much, like there's a faction of, like you guys care about the housing market. You're like, what? You're spending your whatever Tuesday night with me on the housing market. So you must care. But most people don't care like that. They just look at the payment. When I bought my first house, I didn't care. I mean, I did somewhat, but I just looked at the payment basically, right? Most people, when they buy a car, I mean, how many, you look on TikTok or whatever, and you see these YouTube videos on you see these TikTok videos that YouTube creators react to about car payments, and that's all people care about are payments. If I can do the payment, that's all I care about. So I agree that, I mean, this could be the form of quantitative easing or money printing in some weird way that the government's going to put into place if, to stimulate the housing market. Not that it needs stimulated, but to stimulate it, they may put something like this in place, a 50-year mortgage. I don't know. I mean, if you look though at an amortization schedule, I can never say that word, but the A schedule, it's too late in the evening. When you go to 50 years, it doesn't make that much of a difference. When you go to 40 years, it doesn't make that much of a difference. I mean, it makes a difference, but it's not like a huge win. It's just not. Because I do seller financing, we're all proposed 40 years sometimes to get the payment lower. I've even gone to 60 years, but it doesn't make a huge difference in payment. And unfortunately, I think there are people that if it makes just a small difference in the payment, they will bite on that and go with a 50 or 60 year versus a 30 year for a few $100 a month, unfortunately. And bank bailouts, right? There's going to be, right? It's like plan as such. Don't be surprised when there's a bank bailout. So plan accordingly. That's why I'm an advocate for paying minimal attention to that monkey business that you can't control and finding an opportunity in spite of that and not letting the fraud, greed, and corruption win. Because if you wait for the dust to settle or for the fraud to be wiped out of the system, you're going to be waiting forever. There's no one coming to save you in the housing market. I can guarantee that. That's one thing I can guarantee. Nobody's coming to save you. You got to save yourself. Oops. Let me do this. Patrick Cooper. What's up, Patrick? I like those glasses. How in heaven's name do you not know? Not know what? I don't know what you're talking about. Trump is ending forbearance in September. Well, it's not forbearance. It's you're onto something. They're changing or they're closing some loopholes with loss mitigation with FHA loans, but they're still going to have loss mitigation procedures that they've never had previous to COVID in place. And those are like, hey, I don't make my payment, the government makes it for me and puts it on the backside of my loan. And I can do that once every 18 months. Now there's no limit. Like there is a limit as far as how much you can do, but you can do it like over and over again. I think up to 30% of your total loan right now. I think that the new applications have ended for that. And I think the program overall is going to be phased out in September. But there's still going to be the ability to go into forbearance based on the info I read from the FHA. So that's still in effect, but they're going to close those loopholes. Can you do Pocahontas, Pennsylvania? Poconos, not Pocahontas. Poconos, Pennsylvania. I'll write that down, but you should join us on the live when I do my Redfin update because I will do that area. I don't have it on this map or on these charts. I only did the top 100 metros, and the Poconos are not in the top 100. How in Lord's name does someone not care about the price and how long they have to be a slave to the bank? Well, because everything else in their life probably revolves around payments, right? Like it's just like the attitude like, hey, that Resi Club subscription is only $50 a month. Not a big deal. $50 a month, I can afford that. Well, that ends up being what, $600 a year, right? Now, instead, you can buy the subscription for like $300 for an entire year up front. It's something like that. I don't know if those numbers are exactly right, but you get my point, Patrick. And then it's a lot less cost, right? But majority of consumers look at payment first, price second. And that's why you see home prices have continued to escalate and especially when people now start getting ARMs, because they look at that rate and they're like, oh, I can get an adjustable rate mortgage. It's a little bit lower. It's worth the risk because my payment's $200 less. Or I can refi and save myself $150 a month, but reset that amortization schedule. I can never say that word, all over again, right? To a point that they're always going to be a slave to the bank on it. So a lot of people don't care about the price. They just care about the payment. I'm not saying that's right. I'm saying that's fact, and that's human behavior. So I think it's great. One of the things that bothers me a lot, or I get sad about, and I'm like, man, I wish people would just realize that the consumers are stupid. The average consumer is dumb. They're just dumb animals. They're going to act like that. So when you know how they're going to act, plan accordingly. Ocean. Oh, you wanted the Poconos. That's cool. Hey, Steve, how you doing? Sorry, I'm about to end this thing, but it's good to see you this evening. 100% Patrick Cooper. He's right, yeah. Slave to the lender. Sure. Consumers need education. They absolutely do. They absolutely do. Love all your shows. Thanks. I appreciate you joining me here. Going back to the consumers, though, and Steve's comment, and Patrick's too, TM, all you guys have the same kind of comment, which is you need education. But no matter what we do here on YouTube, consumers aren't going to be educated like that. And they're still going to always buy on payment, I think. I will say, though, and don't kill me for saying this, but I will say that it depends on what your goals are regarding payment and price. And it depends on what you're buying. So I have no problem giving a seller a higher purchase price for an investment property anyway, if I can get favorable terms from them. So what I mean by that is there are deals I've negotiated where I buy a duplex and I ask for a small monthly payment, and I do seller financing. So I say, hey, Mr. Seller, you were asking 100 grand for this property. I'll give you 125 instead. I'm sorry, you're asking 125. You're getting offers at 110. I'll give you 128 instead. Over asking. I will pay your closing costs for you, and in return, I want a payment of $500 a month for seller financing for the first 2 years of the loan. Then I'll up the payment to, I'm making all this up, but up a payment to $750. And I don't care that I paid more for the property. And sometimes I've even done interest only on investment properties at first. Why? Well, because if it's going to cash flow a ton and I want to get access to the property to start to work on it, sometimes that makes sense. But that's probably one of the only situations where it makes sense to not care about the price. And you still, even then, you got to care about the price somewhat. You don't want to pay 300 grand for the property if he's asking 100. But you get my point. It's not all, payment is, or, if I went and bought a new home right now, like if I know, I think it was Michael Zuber, the guy that runs one rental at a time. I think he moved to Vegas and bought like probably a really nice home, but he got like 30-year fixed money at like 3% or something. Well, he probably paid for that somehow in the house, right? But he got 30-year debt at 3%. Can't beat that. So like in that situation, maybe it makes sense to pay more for the home. But in most situations, price needs to be a concern, and probably your first concern, not necessarily payment. That's my pitch on the payment. See if I got anything else. Money is made off stupidity. Sometimes, yeah. Seller financing is how I bought my little $25,000 home. Sweet. Gotta like seller financing. It's all brick. Gotta love brick homes. Then refinance. Bank of America paid the owner off. Very good. Get a good attorney for the closing. Yes, you can. And you don't need a realtor to buy something on seller financing. You don't need a realtor. Find something off market, offer seller financing, avoid the bank, and yeah, ultimate freedom. So, okay, guys, listen, I'm going to end this. We've had a great conversation. Thank you, TM. Thank you, Steven. Thank you, Patrick. I'm sure I'm missing other people. DJ Forecast, all you guys. Thank you so much. Look for another video, maybe a live tomorrow, hopefully. And I've got a great 2008, 2025 video walk and talk type thing in some neighborhoods around here that you hopefully will find interesting. Thanks for all your support. I greatly appreciate your time tonight. And I'm the Housing Nerd, and I am out. OUT.